Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what big companies are trying to tell us and sometimes what they are not saying. In this video, we are diving into AC Worldwide Inc., its latest quarterly report, Form 10Q. Now, this filing often feels like a business report card, and let us see if AC Worldwide Inc. got an A or maybe a C-. Also, if you like having complex financial documents broken down into plain English, consider subscribing and joining our Discord community, linked in the description below. It is a great place to talk all things corporate finance. Here we have AC Worldwide Inc. as financial statements for the quarter ending the 30th of September 2025. Let us jump right into the heart of it. Looking at their balance sheet, a snapshot of what the company owns and owes as of the 30th of September 2025, total assets were about $3.16 billion. This is up from $3.02 billion at the end of 2024. So the company is growing its asset base, which is generally a good sign. But what about liabilities? Total liabilities are around $1.68 billion in September 2025, up from $1.6 billion at the end of 2024. This means their debt and other obligations have also gone up, which is something to keep an eye on. Now let us talk about their earnings. For the 3 months ending the 30th of September 2025, total revenues were $482 million. This is up from $451 million in the same period last year, about a 7% increase. Not too bad. Looking at the larger picture, for the 9 months ending the 30th of September 2025, total revenues hit $1.27 billion, an increase of 12% from the same period in 2024. That growth is solid. Their biggest chunk of revenue comes from software as a service and platform as a service. For the 3 months, this revenue was $246 million, up 11%. For the 9 months, it was $755 million, also up 12%. This shows their cloud-based services are doing well and are the main engine of their growth. License revenue also saw some growth. For the 3 months, it was up 3% to $161 million. For the 9 months, it jumped a strong 20% to $303 million. This suggests they are still selling new software licenses effectively, but it is not all good news on the income statement. Their cost of revenue has also increased. For the 3 months, it went up 13% to $223 million. For the 9 months, it shot up 13% to $671 million. This rising cost of delivering their services eating into their profits. Notice how cost of revenue is also a bigger percentage of total revenue than last year. Despite higher revenues, operating income for the 3 months only went up 4% to $127 million. For the 9 months, it was up 19% to $221 million. So while revenue is growing, their operating income is not keeping pace. And then there is interest expense. For the 3 months, it decreased 19% to about $15 million. For the 9 months, it decreased 21% to about $44 million. This is likely due to paying down debt, which is good. Now, look at that other net line. For the 3 months ended the 30th of September 2025, it's a gain of $1.6 million. Last year, for the same period, it was an expense of $800,000. For the 9 months, this line item is a gain of $18.9 million. This includes a significant gain on the sale of an investment. Things like this can make a big difference to the bottom line, but do not necessarily reflect the ongoing health of the core business. All of this leads to net income. For the 3 months, it was $91 million, up 12% from the previous year. For the 9 months, it was $162 million, a jump of 55%. This big jump in net income for the 9 months is largely boosted by that investment sale we just mentioned rather than just pure operational growth. Let us look at their business segments. Payment software is their biggest segment. For the 3 months, revenue was $284 million, up 4%. For the 9 months, revenue was $664 million, up 12%. The biller segment, which handles bill payments, saw revenue of $198 million for the 3 months, up 10%. For the 9 months, it was $614 million, up 12%. Both segments are growing, which is positive. What about profitability by segment? Their segment adjusted EBITDA shows the operational profitability of each segment before certain expenses. For payment software, it was $181 million for the 3 months of 2025, a slight increase from 2024. For the 9 months, it was $371 million, up by $44 million. For biller, Segment adjusted EBITDA was $32 million for the 3 months, up modestly. For the 9 months, it was $102 million, up about $3.7 million. So while both segments grew revenue, profitability growth was more pronounced in payment software for the 9-month period. Now let us talk about cash flow. For the 9 months ended the 30th of September 2025, the company generated $201 million from operations. This is down from $232 million in the same period last year. So even with higher revenues, they are bringing in less cash from their day-to-day business. Investing activities provided a positive $19 million in cash this period, mostly from selling an investment. Last year it used $31 million. This is a one-time boost, not a recurring positive cash flow source. Financing activities used a substantial $235 million in cash. This was largely due to redeeming a significant chunk of their debt, namely those 2026 notes for $400 million. They also repurchased stock. As of the 30th of September 2025, ACI had $199 million in cash and cash equivalents, down from $216 million at the end of 2024. Their total liquidity, including their revolving credit facility, is around $557 million, a decrease from about $744 million at the end of 2024. The company did draw down on its credit facility to help pay off debt, which explains a lot of the decrease in liquidity. Looking at employee compensation, stock-based compensation expense for the 9 months was $45 million, up from $30 million last year. This means they are giving out more stock in lieu of cash to employees, a common practice. The company also repurchased shares to cover taxes on stock awards. This cost about $23 million for the 9 months. And they bought back their own stock, spending about $150 million for the 9 months. They have a stock repurchase program with about $207 million still authorized. On the 31st of October 2025, even after the reporting period, they authorized a massive $500 million for future share buybacks. This signals management's confidence in their stock or a desire to return capital to shareholders. A key accounting policy worth noting is their revenue recognition approach. Given the complexity of their software and service contracts, timing of revenue recognition can have a big impact. They are using specific methods to account for revenue that will be earned in future periods, which is standard. Looking at revenue by product category within their segments, the payment software segment revenue is quite diversified across merchant payments, fraud management, real-time payments, and issuing and acquiring. This shows a broad portfolio within this segment. The biller segment is almost entirely driven by bill payments, which makes sense for that business. Geographically, the United States remains their largest market, bringing in $253 million for the 3 months and $766 million for the 9 months. The other category, which includes international, is also substantial at $228 million for the 3 months and $512 million for the 9 months. Their long-lived assets are pretty evenly split between the United States and other locations, indicating a global presence in terms of their physical and intangible assets. Their effective tax rate has been around 22 to 23% for 2025, which is reasonable, but fluctuating tax rates can always add some uncertainty. Now, when we look at what management is saying, they always include a section on forward-looking statements. They are talking about future operations and strategies, but they also put out a significant warning. They remind us that many things can go wrong and actual results could be very different from what they predict. This legal boilerplate is important to remember, looking at ACI Worldwide Inc. From a higher level, they are growing their revenue, especially in their cloud services, which is great. The increase in license revenue is also a good sign. They are also managing their debt well by paying some of it down. However, their costs are rising faster than their revenues in some areas, putting pressure on operating income. The big jump in net income for the 9 months and the large buyback authorization are definitely interesting points. The investment sale provided a nice boost, but remember, it is a one-time event. The company is clearly investing in its capabilities and growing its core business. The question is whether they can outpace their rising costs and continue to deliver strong profits from those growing revenues. For investors, it is crucial to watch how their cost of revenue and operational expenses trend against their revenue growth in the coming quarters. Alright, that is our deep dive into ACI Worldwide Inc. for the quarter ending the 30th of September 2025. What are your thoughts on their financial performance and future outlook? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more unvarnished looks into company filings. And again, check out our Discord community linked in the description to keep the conversation going. Thanks for watching, and we will see you next time on Corporate Decoder.